the US is almost incentivizing you to leave and earn money abroad by offering you this tax break at the federal level, giving you this almost silver bullet where if you're able to follow these set of criteria, then you can drastically lower your federal income requirement.
Move abroad, you can take about 125,000, which results in about 20 to 25,000 of federal income tax back in your pocket if you're eligible for the exclusion.
How can we travel where we want to, when we want to, while still being in compliance with the rule?
Have people that expatriate and they continue to receive U.S. Social Security, but we can't convince the Social Security office that they're not residents anymore because the two things, they just don't talk to each other. It's not an efficient train that we're on. Today I have a call that we're going to record with a client named Nick. He's an entrepreneur and he's moving abroad, has questions about the foreign earned income exclusion and running a business outside the U.S. and what's available, trying to get in between the lines of what the rules say versus the practical approach to applying those rules. I'll let you speak for yourself here, Nick. If you don't mind, give a little overview of what you have going on and we'll jump into it.
Well, first off, thank you so much, Alex. Appreciate that intro. So a little bit about myself. I'm a serial entrepreneur who started his first business when he was 13. Ever since then, I've been growing and selling businesses in the e-commerce space. Since done a few exits where I, in my opinion, way too much tax here in the US, both at the federal and state levels. So now, before starting my next business adventure, kind of optimize tax and living situation with foreign earned income exclusion. So into this conversation and pick your brain.
Yeah, for sure. Let's do it. I know you prepared some stuff to kind of walk through. Yeah, if you want to share your screen and we can go through it.
Just for the viewers watching, I want to both discuss things that'll be beneficial for my situation, but also kind of backtrack and, give some advice / guidance on for the viewers. So in my opinion, who this video is specifically meant for is either for like your business owner or anyone who has the possibility for virtual / remote work, and you're looking to move overseas potentially in order to lower your tax burden at the federal level. I would say that this conversation would definitely be beneficial. That doesn't apply to you if you don't really care how much tax you pay and you're not really interested in living abroad. I would not stick around, but that does pertain to you. I think you could find a lot of value in this conversation. So Alex, if you wouldn't mind taking over and explaining just briefly what the Foreign Earned Income Exclusion or the FEIE is.
The Foreign Earned Income Exclusion, it applies to U.S. people who live outside the U.S., and we'll talk about some of the specifics of what that means. But it allows you to exclude up to about 125,000 U.S. dollars of your foreign earned income every year, assuming you qualify for one of the tests. And foreign earned income, basically foreign just meaning you're physically outside the U.S. providing those services, and earned meaning it has to be from a self-employed business or from salary. And it gets a little more, it can be from other businesses as well. So yeah, there's some nuances into all those definitions, but that's the basic idea. Move abroad, you can take about 125,000, which results in about 20 to 25,000 of federal income tax back in your pocket if you're eligible for the exclusion.
And that amount is not the same each year. It changes each year with inflation, right?
Right, exactly. So we got a pretty big jump in 24.
So basically to build on that, the US is almost incentivizing you to leave and earn money abroad by offering you this tax break at the federal level. To my understanding, Alex, you can correct me if I'm wrong, but this doesn't excuse you of any state tax. So if you're still a resident of New York or California, for example, you would still owe the state tax.
It depends on the state. Some states, for example, I live in Alabama. Alabama allows the foreign earned income exclusion, so it still applies. So you just have to go state by state. California and New York in particular, they don't allow the foreign earned income exclusion. The truth is, it's hard to claim that you're eligible for the foreign earned income exclusion and you're still a resident of a state in the U.S. because most states have an abode concept or domicile. So if you're claiming to be a resident of state, you're kind of going against the idea that you're a resident for foreign earned income exclusion purposes. So generally what we're trying to do is get you out of resident status in that state.
Fair enough. This is probably, in my opinion, one of the most, Alex, please correct me if I'm wrong, the most cut and dry ways to significantly lower your taxes, where the IRS is basically saying, hey, if you follow these rules that we set out here, even though we're basically the only nation on earth that charges you based on citizenship-based taxation instead of residency-based taxation, we are giving you this almost silver bullet where if you're able to follow these set of criteria, then you can drastically lower your federal income requirements. Is that correct?
Yeah, I mean, it's really the only way you could have earned income, so salary or self-employment income, and pay no U.S. tax. The only other way is there's a Puerto Rican option, which is more complicated. But otherwise, maybe there's some there are ways you can defer your income to a different time. But as far as just a straight, you can move here and not pay any taxes, that's the foreign earned income exclusion is only one. I guess expatriation. But I mean, the whole point, the foreign earned income exclusion, the point of it is it allows you to, in one way, combating double taxation, but the foreign tax credit does that. Really, the original intent of the foreign earned income exclusion was international competitiveness. Because we have a citizenship-based taxation structure, it was making our workforce uncompetitive in foreign jurisdictions because we were paying double tax going to these places. So that was the whole point of it. And honestly, it doesn't get a whole lot of attention year on year. It's just pegged to inflation. And it just kind of sits there and goes off into perpetuity. But yeah, it's very simple and it's the easiest way to just straight up get out of paying taxes because it's not tied to paying tax in the foreign country. So you can go to a foreign country that either has no income tax or somehow you get around their taxation based on their residency rules, or you don't actually land in another country. And we can talk about that too, like hopping around where you're never actually a tax resident anywhere. That doesn't matter. It's not tied to your residency status in a foreign country from a tax perspective, if that makes sense.
Right. I think that's one big misconception. A lot of people who first start learning about this concept is they think that they need to show receipts or pay tax in a different country in order to be eligible for the FEIE. That's not correct. You can pay zero tax in any country outside the U.S. and still claim the FEIE perfectly fine. Is that correct?
For sure.
So let's move on to the overarching objective of this conversation. We know the rules. They're listed right there on the IRS website, but the question is, how can we travel where we want to, when we want to, while still being in compliance with the rule? There's a lot of content online. I'm sure if you're watching this video now, for the viewers, you've probably already seen some other videos on this topic. A lot of the content that's already posted, whether through blogs, or other pieces of content, is very cut and paste. My goal here is to get a little bit deeper into like nuanced nature of the FEIE and kind of go through some real world examples and kind of cut through the BS of like, this is exactly what you need to do. And if you don't, then we're not talking about it. Like, let's actually go through each example and see what the practicality is. How does that sound, Alex?
Yeah, for sure. Yeah, we kind of talked about it before. A lot of the stuff online you read and it's just like, you have to have an abode in the foreign country. Next question. Like everybody's supposed to know what that means, So yeah, let's look at some real examples. And just like as a heads up, it's not always objective. It does come down to a figuring out of, a question of how close are you, or, where are you on the right side or left side of the rules, and making an informed decision about if you were challenged on this position, would you most likely win or not? And that's what I try to help my clients do. I mean, a lot of times it is very clear, but it can definitely get in that gray area. And then it's a decision of, all right, what happens if we were challenged? What's the worst case scenario? What's the likelihood? And then you as the taxpayer can make an informed decision about if you want to move forward with it.
Right. And I think that gray area and lack of explanations from people online is what I think people get scared of when it comes to this topic, because they think if they're not following everything to the T, which we're going to go through the requirements to be eligible of the FEIE, then they think they're not eligible whatsoever. But it's almost this gray area where sometimes in some situations it may work, but also may depend on some other things. So I'm looking to kind of get some clarification on that and pick your brain on that.
Let's do it.
In our conversations, let's make a few things clear. First, let's focus on the practical, real world assumptions of things. So I'll just throw out an example. In Mexico, the law says that people who live there for over 183 days, I could just be making this up, I don't know. You live there over 183 days, you legally have to pay tax, but no one ever does and no one ever gets caught. Let's just assume that in the real practical world, that's not true during our conversation.
Okay.
The examples that I use for countries can basically be swapped and freely exchanged with any other country. So if I say the UAE, or if I say Indonesia or Mexico, those aren't exclusive to those countries. I could, I'm just using them for examples. For the purpose of our conversation, I'll be speaking both in terms of generalities for people who are just learning about this topic. I might just be playing devil's advocate, even though I myself may know the answer, just to get the answer from you for the audience to learn. But towards the end, I'm going to be going towards my specific situation as well, because I'm still learning about this topic too.
All right, sounds good.
So if we can start by explaining to the audience what the two tests are in order to qualify for the FEIE.
Yeah, so there's two main tests. The main one, and probably the more simpler or objective one, is called the physical presence test. And what it says is that you have to have a tax home outside of the U.S. for 330 out of a 365-day period. So it's not based on a calendar year. You just take whatever day you move. If you move today is January 27th. If you move today, we look at January 26th, 2026, and say, were we in the U.S. for more than 35 days? And if so, then we wouldn't qualify for at least that period. We'd have to move that period around. And so I mentioned you have to have a tax home outside the U.S. A tax home is basically where you live and work. So if you're living and working outside the U.S., that's where your tax home is. And so if you work from home, it would be, where's your home? So your tax home it's pretty simple, honestly. It's where you live and work. What gets people on the foreign earned income exclusion is the caveat where it says, even if you have a tax home outside the U.S., if you have an abode in the U.S., then you're deemed not eligible. So that means even if you're living and working outside the U.S., if your abode is still in the U.S., then you still don't qualify. And the word abode basically means where it's looking at the factors that are not necessarily tied to a profession or work. It's more domestic questions, just practical things like where's your, driver's license, where do you go to church, gym memberships, just everyday life things. Where is a permanent residence available to you? And we can talk more about balancing those things, but that's the abode question. And that's where objectively, it's real simple. If you're a single person and you're renting a place in the US and you decide, I want to move to Costa Rica. And so you end your lease in the US and rent something in Costa Rica and you stay there and you work out of your house. There's nothing in the US tying you there. Let's say you have your abode for all intents and purposes and tax home is going to be in Costa Rica. Where it gets tricky is when you have family or you keep things in the US and you're spending time there. And we'll talk more about that. But, so I guess that's the physical presence test. It's a little more objective in that it actually is a day counting. There's a 35-day rule. You can only be in the US for 35 days over a 365-day period. The next test is the Bona Fide Residence test, which allows a little more flexibility on the days. So you have to be a bona fide resident of a foreign country from January 1 to December 31. So it's a calendar year requirement. So generally like the first year and the last year of your foreign stays is usually not going to qualify because it has to be that full calendar year. The benefit of the bona fide residence test is you don't have to count days. Technically, you can spend more than 35 days in the U.S., but it's the bona fide residence test. You still have to have your tax home outside the U.S. and it has the same abode rule. And the abode rule is very similar to the definition of bona fide residence. That's the one I have a little more trouble explaining just in words because the definition of it has come out of, dozens of types of case law. So it's not like you just go into the tax code and read the definition, but basically they're very similar in that they look at domestic concepts of where do you actually live. So that's kind of the general overview.
Fair enough. Yeah, I think that's a great explanation of both. Just based on your general explanations, it seems like the bona fide residence test is much more appealing than the days test. Why would everyone not do the bona fide residence test?
So it's funny you say that. It's more appealing in that it allows you more flexibility for travel to the U.S. But if that's not one of your factors, my suggestion is usually to use the physical presence test when you qualify for it, just because it's because it's more objective. I feel like it's less susceptible to IRS challenge, whereas the bona fide residence test, it's more subjective. And I think the IRS could look at it a little bit more questionably, whereas the physical presence test, you are outside the US or not, and it's just a little bit, it's a lower bar, I think. So if travel to the US is not that important to you, then physical presence test is what I suggest, just because I think it has less of an audit risk. I guess that's the best way to put it. That's just from my personal experience. I don't know if that's from overall data is true. If travel to the US is important to you, then the bona fide residence test is the way to go. And we just have to make sure, there's no rule saying you can't spend as much days as you want in the US, but the more time you spend in the US, the less likely you are a bona fide resident of a foreign country. So it's just, it's a weighing of your total factors, and we can get more specific. And
I think this ties back into what we were saying before about gray area stuff and how this stuff isn't talked about on other forums. Right. At what point can you spend time in the U.S. and still be considered as a bona fide resident?
Yeah.
Correct me if I'm mistaken. There's no hard line where it's like you're past this number of days, then you're no longer eligible. It's just kind of be 2 months, it could be 4 months, it could be 4 months and 2 days.
I have a client that's been 6 months in the U.S. and 6 months outside the U.S. We still claim bona fide residence exclusion for them because they meet all the other factors, which is their family is all in the foreign country. They have kids in school in the foreign country. They own a home in the foreign country. His wife works in the foreign country. They go to church there. He only goes to the U.S. for work, and then he comes back for home, and he goes and he works in both places, so that's where it gets a little bit tricky with the tax home. So if you get to a 6-month period, you got to be real careful. I think if you're doing 6 months, you got to really have all the other factors heavy on the foreign side. But the thing to remember too, is that if you're spending 6 months outside the U.S., it's this guy, he's eligible for the Foreign Earned Income Exclusion, but half of the time he's working in the U.S. So it's still U.S. sourced income. So let's say he makes $125,000. We claim the exclusion, but he's spending 6 months working in the U.S. He's only eligible for $62,000 of the Foreign Earned Income Exclusion because we have to source it based on work days, and he's working half his work days. So only half of them are foreign earned income,
Fair enough. Yeah. So it's not just like a cut and dry, like 120,000, boom. It's like also how many days are you spending in the US and how much of that money you made is coming from US sources.
Right.
So I think that's something important to keep note of. And yeah, I agree with you. I think that, those two different tests have different tiers, in terms of the IRS being able to question, one is more cut and dry. Like, are you outside the US for 330 days? Okay, you are. That's pretty significant. You should probably use that one. And I think what makes the bona fide residency test more appealing is the fact that it's more lenient. And because it's more lenient, I think it gets more criticism because more people may be abusing it.
Right.
When they're not supposed to. So for the physical presence test, during an audit, they would ask you, or not, this is something I actually don't know. Do they ask you for your day log as you're filing the form or only during an audit?
Yeah. So you have to provide your travel days on the form. So you file a form 2555 attached to your personal return. And in both tests, whether it's the physical there's a separate section for the bona fide residence test and for the physical presence test. You fill whichever one out is relevant or whichever one you're claiming. But in both of them, you have to list your U.S. travel days. So they already have that.
So yeah, you need to actively be keeping a log of every day you're in the U.S. and every day you're out of the U.S.
And you can get that. You can get that online. I always forget. I think it's the I-93. You can go to the Department of Travel, I think it's called, website. And as long as you're using your U.S. passport, you don't have another passport you're coming in and out of, that's when you can start getting kind of sneaky, I guess. But if you're using your U.S. passport, they know your travel days and you can pull it yourself.
It's interesting. So they provide you with that log. You don't have
then you can get it from the IRS web. Like you can pull that log from the Department of Travel website. They don't.
Is it a blank log or it has your information already?
It has it filled out. So like every time you travel with your passport, it's logging that in the system based on your passport number. So when you go to the website, you type in your passport number and it's going to show your dates of entry and out and exit from the US. I'm not sure if it shows where you went. But it shows your dates of entry and exit.
So it's interesting how they're asking for that information if they're keeping track of it. Are they also wondering where you're traveling outside the US? Is that also a requirement?
On the physical presence test, it does ask for that. I don't really know why they care about that, but I don't think it's so much that they want additional information. It's just a typical IRS thing where the different departments just don't talk to each other. I see that you would think that because the Department of Travel has all this information, they could just get it. It just doesn't work that way. It's like, I see it with Social Security, have people that expatriate and they continue to receive U.S. Social Security, but we can't convince the Social Security office that they're not residents anymore because the two things, they just don't talk to each other. It's not an efficient train that we're on.
Here are some examples. What others things based on my understanding of what other people say, this is what would match the physical presence in terms of what qualifies you. Let's focus on the graph on the left. If you're spending 1 month in the US in January, the rest of the year in one or more countries outside the US, then you would be eligible.
Yeah.
The assumption here is that you're on month-to-month leases and that you are on a tourist visa.
Yeah.
Would you agree there?
Yeah. I mean, the type of visa isn't even going to matter. It's a little stronger of an argument if you have a resident visa there, but tourist visa is fine. You just have to prove that you're living and working there. I would say like a hard stop for people in either foreign earned income exclusion is if you're outside the US and your family is still in the US, if you have a wife and kids and they are still going on about their life in the US, you have a residence available to you, that's going to be a real hard bar to pass that your abode is outside the US. So that's one that I'm not saying it's not possible. There's plenty of cases out there where people have pulled it off, but it's a hard one to pull off. If you have month-to-month leases, having the lease agreement, you're better off if you have like a 12-month lease agreement, just because that shows your intention to stay there for the full year. But I mean, in this case, it's a historical thing anyway. You know, by the time you're doing your tax return, you just have to prove you were outside the U.S. working outside the U.S. for those 12 months. And we'd want to look into what you had still in the U.S. But like, this is a pretty clear example, I think, because, you know, you're not coming back to the U.S. at all after that January period. And so I think it gets a little bit trickier if like let's say every month you were back 2 days. Like if you're coming back for a weekend every month, then it's like, okay, why is he coming back every month for the weekend? Well, that means you probably have a permanent house available to you in the US. Maybe your family's there. Maybe all your friends are still there. Like you go to work in Mexico, but you come back and your friends and all your social life is still in the US. You know, if you were to get audited in that situation, the cases that I've seen when it show what they're arguing is they show some type of like social connection outside the US, that they have friends, they're in clubs. Like if you really want to solidify, you need some memberships and things like a gym membership, church membership, clubs, volunteer somewhere, show that like, this is where I live. Whereas if you're coming back to the US and you still have your driver's license, you're claiming a state residency, you know, but anyway, I'm kind of going a little off on that.
Right. But isn't that the criteria for bona fide residence, not physical presence?
That's what's tricky. So, I mean, yes, but they both have a rule that's where you have to have an abode outside the US. And the definition of abode is very similar to the definition of bona fide residency. It's difficult to explain the difference, honestly, but, abode just means you can't have more personal ties to the US, more, domestic ties to the US than outside. Domestic meaning like not work ties,
That's interesting. Yeah. Cause I think where a lot of, other CPAs or people talking on this topic kind of cut it short is they're like, okay, 330 days, you're good.
Right.
Like,
they say it's just and the truth is, like you said earlier, most of the time that it works out where that's fine, because if you're spending 330 days outside the US, most likely your personal stuff you have going on is more closely tied to the foreign country anyway, because you're barely coming back to the US. So I guess it just comes up less. Whereas with the bona fide residence, it's more highlighted because you're probably spending more time in the US. But
so you're saying it's a requirement in both, but they just sometimes don't check with the physical presence because it's such a big factor. The fact that you're outside so long. So this kind of just like,
I think it's less likely that they are. I mean, just from a statistical standpoint, you're going to have less people that would fail the abode test under the physical presence test than under the bona fide residence test. And who knows how the IRS comes up with how they check people or who they audit and who they don't. But, that type of analysis is part of it. Yeah.
Okay. Now, when it comes to abodes, if we take a look at the right, you could see like in this example, you're kind of hopping around from country to country and still spending 1 month in the US. According to other CPAs and people who talk on this physical presence topic, to them, this would be fine because you're spending 330 days outside the US. Would you agree that this would probably be fine?
Yeah. Yeah. I think in most cases, you're still fine here. I mean, and this has become a lot more common, right? Especially after COVID. I have a lot of clients that don't really establish themselves in one particular country. And that's where the question comes up. They're like, I'm not really a resident of any of these countries. Do I still qualify for the Foreign Earned Income Exclusion? And the truth is, if you're working abroad, like working physically outside the US, even if you're moving around, your tax home's outside the US. And then it comes back to that abode question, like what did you leave in the US? So you need to create some type of clean cut in a way. It's a little harder to establish that abode outside the US when you're moving around a lot, just because you're not going to have a long-term lease. You're not going to like have the social side of it. You're really not going to have as much of that because you're not staying in one particular place. So it makes it harder. And I think it's more important to make sure your ties in the US are buttoned up. For example, if you have a home in the US and you don't want to sell it, that doesn't disqualify you. It's not like you can't keep a home in the US and be abroad and still claim this, but you may want to rent it out, like, or something that kind of shows that, all right, you're not just coming back to this house, or, this isn't some like transitory, temporary thing.
Right.
I think a good way to look at it is like, think about somebody that goes to school. It's the same as the state concept. Like if you live in a state, like if you live in Alabama and you decide you're going to go to the University of Mississippi, you know, the state, Alabama, looks at that as a temporary or transitory thing. So they're going to keep your domicile in Alabama, even though you're living in Mississippi. Your family's still in Alabama, and you're probably coming back to Alabama. So you're not a Mississippi resident; you're an Alabama resident. Kind of the same thing with the IRS. Not that you can't ever plan to move back to the U.S. and still qualify for this, but it has to be like you're moving there with the intention of being there for that time. You know what I mean? Like it's not transitory in that sense.
And that abode is important. That leads me to my next point. It says here, right on the IRS website where they give guidance, to qualify for the FEIE, your tax home must be in a foreign country throughout your period of bona fide residence or physical presence abroad. So we're speaking about abode. This mentions specifically tax home. So if we go back to the previous example, I would say the first one on the left with Mexico is pretty cut and dry. I could probably reasonably say that's your tax home.
Yeah.
But it gets a little bit more confusing on the right, because even though your abode may be not in the US, it doesn't seem like you have a tax home anywhere, especially if you're on month-to-month leases and you're on tourist visas in all these countries. You are probably not able to comfortably say this is my tax home in Indonesia, Thailand, Colombia, or the UAE in this specific example. So what do you do here?
Yeah. So the concept of tax home actually comes from the business deduction code section in section 162, because like you can deduct away from home expenses under section 162 if you're outside of your tax home. So like travel expenses. You have to leave your tax home to be able to deduct your travel. You can't just drive around your town, or driving to work is not deductible. So they take that same concept and apply it here to figure out where your tax home is, and it has to be outside the U.S. It kind of comes down to your intention of how long you're going to be outside the U.S. So your tax home shifts when you decide. So when your intention is that you're going to be working outside the U.S. for more than 1 year. At that point, your tax home is shifted. And if it, like in the Mexico example, your tax home would clearly be in Mexico. But if you're moving around a lot, the IRS has what's called an itinerant worker concept, where your tax home is where you are, so your tax home stays outside the U.S. It just moves with you outside the U.S. So it's not going to be, and you have to actually list your tax home on the form 2555. But yeah, this itinerant worker concept is the one I've been running into more lately than I ever did in the past, where people are traveling around, not actually landing anywhere long enough to make that their tax home.
So is that what they just put on the form?
No, you would put, like in that example, I would put each of those countries.
Oh, so list out each of those countries as your tax home. Multiple.
Right. And so I would say Indonesia, Thailand, Mexico, Colombia, UAE, all during the year that you established a tax home, ended it, and moved to another tax home.
Interesting. So your tax home doesn't necessarily need to be in one country during the year. It could be in multiple countries.
Right.
Itinerant.
Right. Yeah.
Interesting.
It's
funny you mentioned that, because that was actually my next point. If you read the bottom, that last paragraph, it says, if you do not have a regular or main place of business because of the nature of your work, you may be itinerant. This is a conversation I personally got into with a different CPA who also specializes in expat taxes. He highlighted the point, because of the nature of your work. So for someone like myself, who's an online business owner and, works from his laptop and runs his own business in e-commerce, I'm choosing to work outside of the US. And for that reason, it's not because of the nature of my work that makes me go outside the US. So I would not be able to be itinerant. For example, if I was posted up by a company or some sort of government agency in multiple countries. So let's just say I had to go to like Iraq for 3 months, and then like, South Africa for 3 months, because that was my job and I had to travel there for, let's just say, I don't know, photography or naval duties or whatever.
Right.
That's because of the nature of my work. in terms of working online as a self-employed business person, that's not necessarily the nature of my work. So what's your response to that?
Yeah, I mean, I guess I would wonder if that's true, then where would you say your tax home is? Still in the US? I mean, you still have to.
That's what he was assuming. He was assuming you're not able to be itinerant, so it's reverted back to the US.
Yeah. Yeah, I mean, that's not the way I read the rule. And I've never seen it actually applied that way. The concept of itinerant, I mean, I think you could argue that the nature of your work is itinerant in your case. Like, it doesn't have to be an employment requirement for it to be itinerant. The nature of your work, you could just choose to be itinerant. Especially if you're self-employed, you can choose the nature of your work, the nature of it too. That's the way I apply the rule. Is,
right. And I think this is where it comes to that gray area. It's just like how you interpret this specific line.
Because the problem is that all the case law we have in this, or most of it, is way before remote work was even like a concept. So, I mean, that's part of the problem, is we don't really have a lot of precedent on the remote work style. So, I mean, I could see people taking to me, I'm not going to say that person's like 100% wrong, but I think it's unnecessarily conservative.
This is something we more or less spoke about when it comes to bona fide residency. If you wanted to mention anything else when it comes to specific ties you can prove, I feel like you basically covered most of it, just like visas, property ownership, long-term leases, things like that.
Right. Yeah. I didn't really mention visas, but that's an important one. Like a temporary visa that says you can only stay in the country 6 months is not a great, that's not a great, factor, in your favor. It doesn't kill you, because in some cases you can just, or most cases, but some countries you can just renew the visa right there. Some places make you come back, make you leave and come back, and you come back the next day. With the biggest case out there on the bona fide residence test, it's called Commissioner versus Sochurich. And I mean, it goes through 11 factors. And I'll just read them real quick just so that they're out here. But it's the intention of the taxpayer. Like, do you intend to make the foreign country your home, or was the stay clearly transitory? Like, you're there for a very temporary period. You left all your stuff in the US the same way it was when you were there before, and you go to the foreign country and you come right back and everything was the same way it was. Like, your house still there, your family never left, whatever it is. That's a big problem. Like, to claim the bona fide residence test and you move abroad, there has to be a clear shift in, like, we used to live here and now we live here, So, and the establishment of the home is a piece of that. And that's where it can get tricky with the Airbnbs and VRBOs. It's hard to establish a home with that documentation. But then participation in local community, nature and duration of stay, assimilation into the economy. So like bank accounts and things like that, physical presence in the country. Are you traveling? Like, one big factor you see in cases is like when you travel under the bona fide residence test. So let's say you move to Dubai and you want to travel like for the summer, do you go to the US, or do you go to another foreign country and come back? Or do you go to the US and come back to Dubai, as opposed to like the US becoming your home base? Is the foreign country your home base for travel? That's a big one. And then,
right. And I think that's a great example, because a lot of people who do the traveling and work online in these positions already have that like mindset where they want to be in the best location possible for them. And like, in the world we live in, like, most places have seasons. So Dubai is a great example. In the summertime for 3 or 4 months, it's absurdly hot.
Right.
So it's pretty unreasonable to think that someone would be living there during those 4 months. So does the IRS even take into account that, like, okay, if you're gone during these months where most people are gone in Dubai, they go like to different countries, do they even factor that, or like they don't care?
No, they would definitely factor that. Like, that, to me, that's assimilating into the culture and environment of that country. You live there, you go to, I don't know where people go during the summer, but somewhere less hot, somewhere out of the desert, and then you come back. I guess that's the point, though, is like, are you coming back here, or are you going back to the US during that time potentially you could argue that maybe the US is the main spot and you're vacationing more or less. I guess that's kind of a way to think about it, is like, is this like a long-term vacation that you're taking in this place? Or are you actually moving your life to this foreign country? It doesn't mean you can't come back to the US, but are you going and coming back to your life in the foreign country? Like, and I think like broadly, that's the way you have to think about it. If you start thinking about it that way, the factors will start to line up, where if you're going to actually move to a foreign country, you're probably going to want to make friends. You're probably going to want to have a bank account. You're probably going to want to be able to drive a car, things like that. They're going to start tipping that scale in your favor.
Right. The friends thing is something you keep bringing up.
Yeah.
How do you prove you have friends in any place? Like if the IRS asks you for proof, you're like,
yeah, it's a good point. I don't know why I stress that so much, but I think it's just because the cases that I've read, that's been a big factor in the win, or it's at least been one of the factors, is that they're able to prove some type of social tie to the foreign country, because I think that really proves that you're assimilating there. And the way that they've proved that in the cases, yeah, I mean, it's not like you get a letter from a friend saying, I promise we're buddies or whatever. It's more like you were a member of this social club. At the end of the day, if it came down to you being in court and having to prove this, then you are just saying under oath what is true. So at that point, it kind of depends on the stage of having to prove this. Of course, on the tax return, you're not mentioning anything about your friends in Dubai. And and just to be clear, it's very rare that you get to this level of of IRS, challenging this sort of thing. I'm just coming at it from a nerdy perspective of reading the cases and seeing where it is. But I mean, it is a challenged area for sure. And if you put on your tax return, if you claim the Bona Fide Residence test and they ask you questions about your visa, do you have a home in the US? If you go in there and you show that you were in the US for 6 months, you have a temporary visa in this foreign country and you can't work there, and you have a home available to you in the US and it's not rented out, there's a good chance the IRS is going to come ask questions.
Right. Now, when you say home available to you, are you saying like a home that you own, or like could that even be a home that you're visiting for family?
Yeah, good point. So on the form it asks, let me pull it up real quick just so I don't say it wrong, but I'm pretty sure it asks a home that you lived in. So it says, did you maintain a home in the US while living abroad? So to me, that's a home that you own and are responsible for keeping up. So then it says, if you say yes, you have to enter the address of the home, whether it was rented, the names of the occupants, and their relationship to you. And so that's where I'm saying it can get a little tricky if you answer on line 15B, the name of the visa, and you say no visa or temporary visa, and then it says, did your visa limit your stay in the country or employment? And you say yes. And then you say, I maintained a home abroad. And then you say you didn't rent it out. Those are not that all of those can necessarily disqualify you, but you're going to have a harder argument.
Right. And I know in some countries, there's like 6-month tourist visas where they're still considered like tourist visas, but it's 6 months long.
Yeah.
So if you're like renewing both of those, you're technically not on like a resident visa or anything. You're not a resident of the country, but you're a tourist, but you're be there the whole year.
Right.
So like, what would the IRS think of that if you're like marking off tourist on the form?
Right. It's a tricky situation in a way, because if you claim the foreign earned income exclusion in that scenario, you're saying you have a tax home outside the US in that place. And that means you're working there, but your visa says you can't work there.
Exactly.
So
tourist visas, you're typically not allowed to work.
To me, but the US tax rule for the foreign earned income exclusion is not tied to your residency situation in the foreign country from an immigration perspective. So you can be a tourist in that country and still be truthful to say you're working there. Now, you're probably violating some immigration law in the foreign country, but that's irrelevant for me preparing your personal tax return. I don't really care about, Italy's immigration rules. I don't have anything to do with that. If you're working in that country and you meet all the other tests, but the immigration law says you're a tourist visa, you still qualify for the foreign earned income exclusion. And I don't have any I haven't seen that cause a problem because honestly, I mean, it's pretty common because, a lot of Americans, I mean, the truth is it's hard for a foreign country to know when somebody moves there and is working from their hotel room. You have the same problem in the US. I have people that come here and technically, if you're a foreigner and you move to the US and you're working here, you're supposed to file the tax return and pay taxes on that income. Not many people do that, because how could they possibly know when you were working here? And so you do. So I see that a lot, I guess is what I'm saying. And I don't see a problem with still claiming the exclusion.
Okay, so it doesn't automatically disqualify you, and the IRS isn't necessarily looking at, okay, he's a tourist and he's not supposed to be working, so we're just going to disqualify him.
Not at all.
Now, in terms of the Bona Fide Residence test, this is something that I was told. This is very important for the first year specifically to be in the country you want to claim bona fide residence by January 1st. Is this true?
Yeah, the bona fide residence test is specific to a calendar year. So you can't claim it for a partial year like you can for the physical presence test. So really, what it comes down to is that first year, you need to, you're going to claim the physical presence test unless you leave on December 31st, really. Because the way you calculate whether it's a US or a foreign day, a travel day is a US day. So that day that you travel from the US to the foreign country, that's a US day. So you really got to go on December 31st, wake up there January 1, and then you can do the bona fide residence test.
Right. And that's only for the first year is what I was told. So if you're there by January 1st, the first year, and then by the next year, if you're still a bona fide resident of that same country and you want to take that exclusion again, you don't have to be in that country. You could actually be in the US on January 1st of the next year. Is that correct?
That's true. Yeah. Basically, the clock starts at when your tax home has shifted to the foreign country. So if your tax home shifts on July 3rd of the first year, maybe we look at a way to claim, and that's where it gets a little tricky. If you move on January 3rd of 2025 and you don't come back to the US, you can claim a foreign earned income exclusion for that partial part of 2025 from July to December, because your qualifying period will be July 25 to July 26, because the physical presence test is not based on a calendar year. It's just on a 365-day period. So
you'd be qualifying for 2 years if you did that route.
Well, you qualify for one period. So on your 2025 tax return, you would qualify over that period. And then in 2025, you could take the July to December prorated portion of the $125,000. Then in 2026, you're not tied to, that's what confuses people. What you claimed last year that went to July of 26 is not relevant to what you do on your 26 return. At that point, we could claim the full year under the bona fide residence test because your tax home started in July of 25. And if you stayed there through December 31 of 26, in 26, we'd claim the bona fide residence exclusion, bona fide residence test. Or we could do either one.
Doesn't the clock start ticking on January, not July?
Well, yeah. Well, yes. The bona fide residence test is you just have to be a bona fide resident for a full calendar year, January 1 to December 31. So technically that bona fide residence started in July of 25, but as far as your qualifying period for a particular year, it's just January to December.
Interesting. Okay. So I think it's very important to highlight that it does get more flexible in subsequent years. That first year is very important, actually being in the country by January 1st. So if you're looking to travel to that country around December or January time, if you miss that hard deadline, then you have to claim physical presence. You can't do bona fide resident for that year.
Right.
If you're spending more than, 35 days in the US, it would be like 2 months.
Mm-hmm.
This is pretty straightforward. This is what other people would say also, and I basically agree with them.
Yeah, I agree.
So now if we take what we spoke about and apply it like theoretical example, this should be the last slide. for example, someone who's a Mexico temporary resident, um, but we're staying in Indonesia for longer. So Indonesia's 7 months, Mexico is 5 months, but we're actually sprinkling in some time in the US and some time traveling elsewhere. I can mess around with this and you can tell me what tests you would do and how you would qualify. So if I change this to US, then how would you go about this?
I mean, in that scenario, you would qualify for the physical presence test because you'd be under the 35 days. So my general suggestion would be to probably do the physical presence test just because, like I said before, it's a little less scrutinized. But let's say you had another US trip in there, during the year that got you over the 35 days.
Right. Let's say like this is US as well.
Yeah. So in that case, your only option, well, I guess you have two options. You would claim bona fide residence for the full year. And in that, if we're going to do that, we'd look a little harder at your ties in the US. Like if you sold your home in the US and moved abroad and you work abroad, to me, it'd be very hard, for the IRS to claim that your abode is still in the US if you have no place to go in the US. That's why I think the biggest factor is the home aspect. Like if you don't have a place to go back to, then it'd be really hard for them to claim you have an abode there. But then you start getting into like friends and families' homes. I guess I would look a little harder at that. But let's say you kept a home available to you in the US and you didn't rent it out, but you also had a home in or I guess you wouldn't have a home in the foreign country because you're moving around. But you're setting up long-term leases, you're living outside the US and you have no
These
plan.
wouldn't be long-term leases. This would be like month-to-month leases in this example.
Right.
I should have specified that.
Right. I mean, to me, I think that would start to get a little hard from a bona fide residence perspective if you had a home available to you in the US and in those trips you were going back to that home, especially if you kept other things in the US, like driver's licenses and, you'd really want to cut all the other ties at least. And then we just look at the risk of taking the bona fide residence. And in that case, because it would be pretty gray, I would go back and look at some of the relevant case law and provide my client a kind of a breakdown on whether I think that they would win or lose in a scenario like that. But here, the other option is if you don't go bona fide residence, we'd want to know what happened the next year, like in January through March of the next year, because you could start your qualifying period May 1st and skip that US trip. You lose out on, a quarter of that 125,000 for that year by doing that. That could be a safer, more conservative option.
You're saying just continue on and make this from May in Indonesia down until like the next year. Just be outside the US for physical presence test specific.
Yeah.
Qualify.
So we get the physical presence test and have your starting day be, and there's something called the slide rule. And this gets a little technical, but basically we could start your physical presence test May 1. And so it would go to April 31 April. How many days are in April? 31?
I think so.
No, 30. It's 30.
I'm not sure.
I think it's 30. So you go to April 30. And so let's say you weren't in the US at all during that period, you can slide back 35 days. So generally you'd have to take out 25% because of that year because you only started in May, but you could go back 35 days as far as your qualifying period goes to get you more exclusion. So your actual starting date of the qualified period would be, middle of March. Those are US days, but you're allowed 35 US days. You see what I'm saying? So it gives you
not really
more.
losing days because you're taking part of that physical presence test and applying it to the next year, no?
Well, I guess what I'm saying is so if we say May to April of the next year, you're getting 7 out of 12 months worth of the 125,000.
Right.
but you can you're allowed 35 US days. We could slide your qualifying period back to like March 20th or whatever it would be to get you another month and a half of that qualifying period. So now you'd get 8.5 out of 12 months worth of the 125,000.
That's assuming you don't go back to the US.
That's assuming you don't get right.
Okay, fair enough. Okay. Yeah. Alex, I think you went through everything very in depth, very thoroughly. You answered all my questions.
So I'll just summarize it real quick. I mean, I think the foreign earned income exclusion, it's, like we talked about originally, it's your sure way and simple, relatively, of just excluding wage income from U.S. taxation. Like that, this is really the only thing that exists outside of Puerto Rico and giving up your U.S. citizenship. It's very simple if you don't have a lot of ties back in the U.S. and you move outside the U.S. and you spend less than 35 days. It's really a very simple case. Where it gets tricky is where you leave stuff in the U.S. or you start spending more time in the U.S. and then you want to, we just have to compare those factors. And I would say the biggest hard stop is if you have a family or a home, definitely if you have a family, they have to come with you. Because you can't leave them in the U.S. It makes it very hard to qualify for either of these tests. If you have a home.
Well, let me pause you for a second. When you say family, is it exclusively like wife, kids, or kind of also parents?
Well, I mean, I think I'm really talking about wife and kids. But parents, it kind of depends on your relationship with that parents. Like if you're like a caregiver for them or something like that. But no, I don't mean like family like that you don't live with and don't visit. I mean, the family that you are, responsible for. So yeah. But I'll be honest, it's a much simpler, it can be simpler in some cases, I guess, when you're single. And that it kind of takes that whole factor out. I guess you could look at it both ways, because if you have a family, it just gives you an additional factor that they're coming with you, and if you enroll your kids in a foreign school, that's a pretty strong factor that this is where you live. Whereas if you're single, you don't really have that. But yeah, I mean, I'd say the biggest one is the home. Like if you're going to keep a house in the U.S., rent it out, just so you can show that that otherwise it makes it a little weaker of an argument, I guess.
Fair enough.
Yeah.
So Alex, pleasure. Did an amazing job explaining everything. I guess if anyone has any questions, they can shoot you a comment.
Yeah, for sure. Yeah. I mean, check out some more. I try to do practical stuff like this on my YouTube channel, McGowan Tax. And I'll be putting out more of that. I have a plan of maybe putting out like a client type question every week that kind of goes into detail about a practical thing that's going on and what you can do, and then adding the technical part of that too. But and then you can reach out to me at my website, McGowanTax.com, and happy to have a consultation. Or come on YouTube with me. Tell me your problem. We'll put it on the air.
Perfect. Thank you so much, Alex.
All right, man.